Some stocks look cheap but are expensive, and some stocks are expensive but look cheap. In this case, I want to talk about a stock that, well, looks cheap and isn't that expensive either. Now, when I'm talking about cheap and expensive, in this case, I'm talking purely about people that just look at the price of a share and define it as cheap or expensive, right? Mercado Libre, one share will cost you $1,900, $1,800, maybe right now $2,000, right? That does not mean this is an expensive stock. No, it's an expensive share because, well, they did not split the stock. But on the flip side, if you look at companies that will cost you, I don't know, $7 a share, yeah, okay, it's only $7 to buy the share. That does not make the company cheap or expensive. Could be cheap, but could very well be expensive as well. In this case, I want to talk about a financial company out of Latin America. You've probably already know the name, and that's New Holdings. Now, you can buy New for just $14 or so less than $15 to buy one share. But again, does that make it cheap or expensive? No. You'll have to look at the business, you'll have to look at pricing metrics, etc., etc. Currently, it has a market cap of $67.5 billion and a forward PE of 24.5 times. Now, just looking at this, you can already make a conclusion and say, oh, it's expensive because it's 24.5 times, or, oh, it's cheap because it's just 24.5 times, right? We still don't know what the conclusion is. And so we can dive a little bit deeper here and look at what the analysts are expecting. Sales growth for the current fiscal year, fiscal 25 and fiscal 2026, you can clearly see this is a fast growing company. Sales-wise, EPS-wise, growing even faster. Fiscal year 2024, year-over-year growth is expected to be close to 83%. Then in fiscal 2025, close to 40% year-over-year growth. And then in fiscal 2026, reacceleration close to 45% year-over-year growth. Now I'm sure a lot of people are already saying, yeah, okay, this looks like a cheap company that is definitely worth buying, not just because it's $14 a share, but because, well, the company is growing quite quickly. Pricing metrics are definitely not that expensive. So, this looks quite attractive. Yeah, I agree. This is a company that I used to own. I sold because, well, I bought, it was way cheaper actually. If you look at the performance of New since it went public, it has been performing quite well. So it went public and then it went all the way back down to around $3-4 or so. I started buying it around $4, then it went down a little bit, but then, well, it recovered way quicker than I expected, and then some. I sold all of my position at around $11. Yes, as you can see, it went even higher. Fine. I put it all in Mercado Libre because Mercado Libre was basically a bigger position for me. Wanted to consolidate the portfolio a little bit more. But now, overall, since it went public, New is up 36.11%. Year to date, the stock is up close to 69%, and year over year, the stock is up over 72%. If we currently look at the average analyst price target, that's around 12.7% higher than the price we're at today. Now, continuing here on the pricing aspect, this company has been public for the last couple of years, so we can look at the current forward PE, price to sales, price to free cash flow, and compare it to the 3-year mean. And what do we see? Well, we can see that forward PE, price to sales, price to free cash flow, all lower than the 3-year mean. And I mean, if we look at the forward PE, it's much lower, right? The 3-year mean sits here at 65.5 times. And this is despite the fact that the stock has gone up 36-37% since it went public, right? So the stock goes up, but if we look at the multiples have compressed. Why is that? Well, because the business has just outgrown the stock's performance, right? The stock goes up, but the business has gone up and has become more and more profitable faster than the stock's reaction. Where have we seen that before? We've seen that with Nvidia. Nvidia is up God knows how much in the last year or two. And yet, from a valuation standpoint, maybe now a little bit more, but for a long period of time, this stock was up 600% or something like that. Yet from a valuations perspective, it wasn't that crazy. Why? Because the business has grown much quicker. So it's okay to sometimes look at some pricing metrics, but if you want a full picture and understand what exactly has happened, you also have to look at the business performance. So let's have a look at what New has reported a week or so ago, their latest quarterly results. We can also look at what Warren Buffett has done with his shares, because we got the 13F filings for most of the super investors, and we can see here he did reduce his position in new by 19.31%, but as you can clearly see here, this is a tiny position in his portfolio. And there are plenty of positions in his portfolio where I still don't understand why they exist, right? He opened a new position in Pool Corp, but that's only 0.06 of the portfolio. Also new position in Domino's Pizza, 0.21. So yeah, there are many positions in the portfolio, especially Amazon. He's been owning Amazon for quite a while, which is strange because I thought Amazon would be the perfect Warren Buffett company, especially right now. But okay, then of course the huge decreases continue for Apple, and well, a quarter after he bought Ulta Beauty, he basically sold all of it. Now, of course, as you know, just because he buys or sells stuff does not mean that you have to buy or sell the same position, right? I think that's quite clear. Now, before continuing, if you enjoy this type of videos, give it a thumbs up, subscribe. If not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comments for the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So as always, for the major overview of earnings reports, we have here stock market nerd Brad Freeman on X with the major overview on the left right here. So they beat revenue estimate by 1%, beat customer estimate by 0.4%. They slightly missed 46% GAAP gross profit margin estimate. They beat on net income one and beat on GAAP estimate by 12%. Overall, I mean, this company has been firing on all cylinders, top and bottom line, and on other metrics as well. Zooming out a little bit, we can see how the business has grown in the last couple of years and what the market is expecting it to do in the next coming fiscal years, as we've seen at the start of this video. And then, of course, free cash flow. We're going to use this number here, $3.730 billion in free cash flow in the last 12 months. We're going to use that number at the end for the reverse DCF. All in all, this is a business where the number of customers continues to go up and up and up. And as you can see, total revenue has basically exploded. It's up 706% since Q3 2021 on a last 12 months basis. So you get this big number right here. Then if you look at total operating expenses, yes, it has grown, but it has grown by 260%, while revenue has grown by 706%. And well, net income flipped from being a loss to now, well, $1.78 billion in the last 12 months and increasing. Looking at the major overview for the quarter, I mean, isn't this a beautiful thing to see, right? Look at this. This is insane. Close to 110 million customers. That's up 20.7 million year over year. They've got 56% of the adult population in Brazil with an 84% monthly activity rate. Revenue is up 56% on an FX neutral basis. Gross profit is at $1.3 billion. That's up 67% on an FX neutral basis year over year, and gross profit margin sits at 46%. Net income is up 107% on an FX neutral basis, reaching $553.4 million with an annualized return on equity of 30%, which that's the first time they surpassed 30%. Adjusted net income is up 89% year over year, and adjusted annualized ROE 33%. Now, it's great to see that customers continue to grow and grow, but what's even better here is that active customers have increased faster than customers overall year over year. So the activity rate here continues to go up. Looking at the cohorts, so they say compounding effects of more engagement and more cross-sell driving ongoing average revenue per active customer expansion. So you can see the darker ones are the most recent cohorts and the most recent customers, right? And well, first of all, with regards to the number of products per active customers, before, well, they started with basically only one. Then with the years, well, they start already with more than 3 and probably getting closer to 4, while they're getting to 4 much quicker than before. And of course, this allows them to reach, well, the monthly average revenue per active customers quarterly much quicker. The average here sits at $11. Switching to net interest income and net interest margin. So net interest income continues to go up. That's the purple bars right here. That's up 63% year over year. Net interest margin did come down quarter over quarter and is down a little bit year over year as well. So they say here this slowdown in growth quarter over quarter was mainly driven by the combination of 3 factors: Yields on the credit card portfolio declined, reflecting an improved customer and product risk profile. Lending yields declined as secured loans continue to grow. And third, funding costs in Mexico and Colombia continue pressured in line with New's yield strategy to quickly ramp up deposit growth in new geos. This is basically what they've been telling us, I think, for the last couple of quarters. This is, in their words, intentional. Then moving on to this slide right here. I mean, even at 0.9, the cost to serve was already extremely low, one of the lowest in the industry. And somehow they managed to reduce it even more in Q3. So that's here cost to serve per active customer. This is really mind-blowing stuff. Switching to the loans part. So delinquency ratios tracking expectations. So we've got the 15 to 90 days ones and the 90 plus days ones. So they say the following. The decline in New's leading indicator, the non-performing loans, 15 to 90 observed during the second quarter continued into this quarter, with NPLs decreasing by 10 basis points, which is right here, to 4.4%. Meanwhile, the 90 plus NPL ratio increased 20 basis points sequentially to 7.2%, aligned with expectations. Recall that 90 plus behaves as a stock rather than a flow metric, in the sense that this quarter's 90 plus houses inventory that was in 15 to 90 from 1 quarter ago all the way to 3 quarters ago. Thus, to understand the movement in 90 plus from last quarter to this quarter, it's important to track it back to the change in 15 to 90 from 4 quarters ago all the way to last quarter. And it's important to note that this is only for Brazil. Now, of course, it's great that we get an explanation here, but yeah, we did go from around 3% to now 7.2% here, so that's definitely something to keep an eye on, even after these explanations. Quickly doing the reverse DCF here, so we've got the free cash flow trailing 12 months, $3.73 billion, a terminal growth rate, the discount rate, and so to justify today's price, the implied growth rate here is 2.4%. Now, we've seen that this business is expected to grow much quicker than that in the next coming fiscal years. Of course, we don't have all the growth rates for the next 10 years, but the fact that, well, for the next 2 fiscal years, we are growing, well, much quicker than 2.4%, would be safe to say that, yeah, this price looks quite cheap, right? And this is including 2% dilution for the next 10 years. So yeah, I mean, 2.4%, that's really not that much. If we increase it to just 5%, the upside here is already 23.5%. Quickly looking at the graph right now, big red candle last week after the earnings report. So we went under the 20 and the 50-day moving average. Let's see if we can have a quick recovery above that 50-day one. If not, it wouldn't be such a bad idea to go and revisit that 200-day moving average. Would make this stock extremely attractive at around $12.50. So overall, if you're looking for exposure in the finance space, if you're looking for exposure in Latin America, I think Nu, along with Mercado Libre, for example, are just one of the best plays around. Me personally, I own currently Mercado Libre and actually dLocal as my exposure to that market, to those markets there. Plus, of course, there are some other companies that are operating there, right? Google, Meta, Amazon, and those things. But more specifically, Mercado Libre and dLocal are my plays. I used to have Nu as well. I think Nu, I mean, yeah, it's already a huge company, $60+ billion in market cap. But if they continue like this, I mean, the sky is the limit, right? So overall, that's my thoughts on Nu right now. Do share yours down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.